for a while. Now, the other one for the small and medium-sized companies, it's actually more advantageous if they're of that size. It's something that was put in effect 1986, the year that Time magazine had America, Your Insurance is canceled. That provides that if your captive does $1.2 million or less of premium income per year, it can file an election with its tax return to exempt out the premium or underwriting income from taxation. So that's advantageous. That's also advantageous for smaller, say, property owners who want to maybe cover that first 5% of wind or earthquake coverage, which which they wouldn't get the advantage of the reserve deduction. They can build up some money to protect themselves when they finally get hit, or hopefully they never get hit. So that's very advantageous for the smaller companies. Somebody's saying, wouldn't the hardening of the traditional insurance market create more opportunity for captives? Absolutely. More people, for example, out here in California and some other states are getting substantial increases in their workers' comp insurance. They're looking to do more loss-sensitive programs, meaning they take on part of the liability for the workers' comp back from the workers' comp carrier. The best way to cover that is to cover that deductible portion they retain in a captive. There's more people are looking at that. As liability coverage has increased, more people are looking at taking that on. Same thing with earthquake. So we're seeing more activity in those types of lines than we had before. Does a captive ever become large enough to become a commercial carrier? Yes, I think some commercial carriers that exist right now used to be captives, or at least group captives. Certainly, it's a different type of license. You'd have to get different licensing, but yes, that is possible. All right, now let's go on to our next subject. Okay, let's talk a little about this 831B election. It says 831B captive. There is no really 831B captive. 831B is just a provision in the code with an election. A captive is a captive. It has to have all the elements of an insurance company in their federal income tax law in order to qualify as an insurance company. If its premiums are $1.2 million or less, it can file the election. It pays no tax on its premium income. It does pay tax on its investment income. And again, all captives are C corporations. So you don't get any special breaks for capital gains, et cetera. So when the client is determining its investment portfolio, it should take that into consideration. And its investments, of course, should always be along the lines of what an insurance company would be, because you want to always act like you're an insurance company. And more domiciles are requiring more and more diversification, particularly onshore. Probably get away with less than the offshore, but again, that's offshore. Okay. All right. Now this, let's say this seems too good to be true. You've got the same folks owning the captive that own the insureds. All we've done is taken risks that we were self-insuring before, or that now we've chosen to self-insure because we've gone to let's say we've eliminated some of our commercial coverage. Now we've created this new entity that's C corporation captive, and now we've paid money